On February 19, 2020, the global economy looked untouchable. The S&P 500 was sitting at an all-time high, and trading floors were flashing green. The market was projecting a long, sustained period of growth. Then, a biological virus forced borders to close and businesses to lock their doors. Within weeks, the highly optimized and deeply interconnected supply chains that fed the globe suddenly ground to a halt. In 2008, the financial system collapsed because of internal structural rot, bad mortgages hiding inside the banks. But in 2020, the threat was purely external. The banks and markets were healthy, simply paralyzed by a physical reality they couldn't control. The global economy was functioning exactly as designed, right up until the moment it suffered a sudden and complete cardiac arrest. The subsequent drop broke modern records. In just over a month, the S&P 500 plunged 34%. Around the world, $21 trillion in market value evaporated. This speed was driven by herd behavior. Without clear information on how long the shutdown would last, investors abandoned their own analysis and followed the collective panic. As millions watched their peers dump assets, they followed suit, triggering the fastest plunge into a bear market in history. This is a chart of the VEX, a measure of market fear. It remained relatively flat through the late 2010s, but in mid-March 2020, it spiked to 85, blasting past the 2008 financial crisis peaks. The selling became so violent that stock exchanges repeatedly smashed the emergency stop. These circuit breakers physically halt trading to prevent a total meltdown. For investors watching their screens freeze over and over, it felt like the rules of finance had stopped functioning. The virus initiated the shock, but human psychology weaponized it. Flawed behavioral biases took a biological event and turned it into a historic financial panic. That panic quickly infected the corporate level. As lockdowns were announced, executives realized their revenues were stopping indefinitely, creating a massive, immediate need for capital to keep the lights on. This chart shows the scale of the resulting liquidity crisis. Notice this vertical spike in late March 2020. Terrified public corporations rushed to their banks and drew down more than $300 billion from their credit lines in just 3 weeks. Ford Motor Company alone tapped into $15.4 billion to stay afloat while their plants were dark. As the risk of default rose, the fees they paid to access those funds skyrocketed. The financial system was bleeding out internally. Corporations were hoarding the last remaining liquidity to survive a winter with no end date. This apocalypse was not distributed equally. The old-world physical economy, travel, hospitality, and traditional retail, bore the brunt of the slaughter as global movement ground to a halt. This paralysis pushed the energy market to a breaking point. By April 2020, demand for fuel disappeared completely, and producers ran out of storage space. For the first time in history, U.S. oil prices went negative. Producers were paying buyers to take the surplus off their hands. Meanwhile, the New World tech sector thrived. As physical store traffic vanished, e-commerce and cloud services saw an explosion in demand. For these digital players, the lockdowns accelerated the adoption of their technology by years. The mass shift to remote work forced an instant global reliance on digital communication. Platforms that facilitated stay-at-home life suddenly became the world's essential infrastructure. The crash didn't impact every sector equally. It forced a rapid migration of market value. Capital fled the physical assets that were no longer functional and pivoted into the digital platforms that could still operate during a global shutdown. Faced with total systemic collapse, central banks and governments abandoned the traditional rulebook. They launched a whatever-it-takes strategy to restart the global financial heart. This meant massive quantitative easing. Central banks slashed interest rates to zero and began buying trillions in assets to flood the pipes of the credit markets, ensuring that banks could keep lending and money would keep moving. Simultaneously, governments passed multi-trillion-dollar relief bills like the CARES Act. They sent direct stimulus payments to citizens and launched massive loan programs to keep small businesses from collapsing entirely. With organic economic demand outlawed by the pandemic, authorities replaced it by injecting the largest and fastest surge of printing money in human history. This created an unexpected mutation. Millions of people stuck at home with government cash and commission-free trading apps suddenly became a powerful wave of retail investors. This retail buying frenzy, concentrated heavily in tech stocks, forced a V-shaped recovery. By August 2020, just 5 months after hitting rock bottom, the S&P 500 had recovered all its losses and was back to hitting all-time highs. But that rescue came with a dark side. Pumping trillions of dollars into a system with paralyzed supply chains was the perfect recipe for inflation. The very stimulus that saved the markets in 2020 laid the groundwork for the rapid price increases that followed. We successfully resurrected the global market from a near-death experience, but the sheer volume of capital required to do so set the stage for the persistent inflation and interest rate swings that define the global economy today.
Coiled spring strategy. Profit from volatility before the market breaks.